Hey everyone, so welcome back to the channel. For last week, US have their May inflation number come out and it does not look good. Now on top of that, the World Bank have issued warnings that some countries or the world itself may be approaching stagflation status. And also we do have the June and July rate hikes coming up, and with the recent report, expectations are shifting a little bit. So for today, I want to talk about all of that, and in the end, I want to talk about some tips and tricks that I have been sharing with some of my subscribers and clients in terms of their mortgages, investment, etc. Now before we start, if you haven't already, please help us like this video. YouTube algorithm has been very weird lately. Every single one of your like can help us to push to more people. Now with those out of the way, without further ado, let's jump into today's video. So first, let's talk about inflation itself. Now, data for Canada is not out yet, so we'll be mainly looking at the US, but I would imagine it should print very similar. So like we said, the US number did not look good. It was printed as 8.6% year-on-year change. Now, people were expecting it to reach 8.3%, which means it would be plateauing with April's number. However, like we saw, this did not happen. So far, up until May's number, inflation has not peaked yet. Now this inflation is broad-based, which means every single category has gotten more expensive. But in particular, food, energy, and shelter dominated the increase. Food, we saw a 10.1% year-on-year increase. Shelter, which is rent, we saw a 5%. And gasoline saw a 48.7% increase year-on-year. Unsurprisingly, because of energy price being more expensive, utility and airfare itself saw a 30 and 37.8% year-on-year increase. Now on the topic on whether inflation has peaked or not, a couple of weeks ago, we actually did a video on this, focusing on an article on a blog post called Aprecitas Economics by Joseph Politano. If you haven't watched already, I still recommend you watch it. Even though we're not seeing inflation peaking just yet, I still think his reasoning is very probable and makes a lot of sense. And indeed, just this week, I jumped back in to look at the new updated numbers and compare that to his 3 reasoning on why inflation may be coming to a peak. His reasoning is still going on as expected in the background. So for example, one of the reasons was the Fed is tightening monetary policy. It is bringing down the 5-year break-even inflation expectation. There are also early signs of monetary expectation are stabilizing. Nominal treasury yields and real yields are stabilized as well. Now on top of that, the blog also spoke about handoff effect, which means in normal circumstances, durable goods should come down while services should ramp up, so we kind of hand off the inflation to the other side of the market. And if we look deeper, this effect is still actually going on. Looking at the new stats in US, car production continue to increase, which will increase the supply. Appliance costs continue to decline. Durable goods stabilizes as well. So all the things he reasoned that we should be seeing to suggest inflation are peaking, it's actually happening in the background. It's just that it has been overshadowed by the war in Ukraine and its effect on gas and food production itself. Now, May's number being higher than expected, this is to be expected. It's not surprising given on what's going on to the gasoline price. Its effect is going to be felt. And looking at how things are playing out in the first half of June, I also expect number to be higher when we come to read June's report. So there will be even more volatility coming. However, it is key in the coming weeks to look at what OPEC's production report is looking at. If they're producing at a slightly elevated, higher level than before, then we could have higher chance to expect inflation to really plateau come July or even August. So this coming week is going to be very important because all the important production and all going to be reported, and keeping an eye on it is going to give a very good picture what kind of number we should be reading in the next 3 months. Now moving on, let's talk a little bit about job market, because later on when we talk about stagflation, job hiring is also one of the key things, so we want to pay attention to this. In US, according to June 3rd employment report, wage continues to climb. In May, wages were up 5.2% year-on-year. However, while employer is offering a higher wage, there is still a large gap between job opening and available workers. There are 5.5 million job gaps in April, basically 2 job openings for every unemployed person. In May, they added 390k job opening. It cooled slightly compared to before, but it's still a pretty strong number. Now for Canada, we're looking at very similar. We added 40K job in May. Unemployment rate fell to 5.1% versus the 5.2% we're seeing in April. Average wage rose by 3.9% year on year in May. So despite the fact that the economic outlook is not very good, interest rate is increasing, putting more pressure on people's spending and also hiring process, we're still seeing a lot of demand in the market for workers. Now this is very important because World Bank have issued a warning about possible stagflation scenario. So next, let's talk about what is stagflation and how likely are we to enter one. So stagflation, what is it? It is defined by a combination of high inflation and high unemployment rate. This is one of the toughest economic scenarios to be in for any countries because there is no perfect solution. No matter what you do, you will satisfy one side while destroying the other side because they are working in complete opposite. So for example, if you were to increase interest rate which will fight inflation, you are going to increase unemployment and bring the country into a deeper recession. On the other hand, if you were to lower interest rate, which will increase hiring, so lowering unemployment, inflation is going to run away from you. And the last one we have seen are in the 1970s. So during that time, high unemployment plus oil embargo from Arab to US caused price at pump to quadruple. High energy, slow economy, and goods production. So by 1973 to 1975, unemployment doubled to 9% while inflation peaked at 14%. Now at the time, the Fed chairman was Paul Volcker, and he solved this problem by doing something called the Volcker shock or the Volcker rule, which basically is to raise rates to 20% and it completely stops the economy from moving. Now doing that pretty much kills inflation instantly, and he did try to lower it back down around June. However, inflation came back right away and he bumped it back up to 20% and kept it at 16% until May 1981. Now, the aftermath of this was quite nasty. Even though inflation was killed, it also killed employment completely as no company can afford to borrow anymore. At that time, it was necessary and I think it was very courageous. It's not something that I would imagine any other person as a chairman right now will be willing to do. It's a very, very tough decision. However, back then, it's what it takes to get this done, and he did it. So the question would be, are we now heading to the 1970s style of stagflation that we saw? Now, while there's definitely similarities, for example, energy price going out of control, we also need to look at details. Although like we saw, inflation is very high, at this current moment, employment remains to be very strong and it seems like to get stronger. Now, another thing to keep in mind is that energy price is higher now, just like 1970s, but the economy itself is way different than 50 years ago. Although energy is still an important resource for industrialized countries, they matter less now than they used to. In US, for example, every dollar of output takes 70% less petrol to produce versus the 70s. Nowadays, also a much larger share of GDP itself are on service-based goods. So while slower growth is something that we should pay attention to, it is much harder to face a runaway stagflation that we saw in the 1970s. But still, fighting inflation is the key here, so next let's look at interest rate expectation. Now for this section, I actually have to re-record because as I was editing it, all the numbers have completely flipped. People were expecting a 0.5% increase with a 76% chance. Now the public are expecting a 93% chance of seeing a 0.75% in the next rate hike in the US. And moving on to the July 27 rate hike, people once again have flipped the numbers, again expecting another 0.75% increase with a 76% chance. Now, even though the market has changed the expectation and pretty much everybody is expecting a 0.75% increase upcoming, personally, I still expect a 0.5% is more likely for two reasons. The first reason is we haven't really heard any extra comment from the Fed about the rate hike announcement that will be happening on Wednesday. Usually, if they're going to do something that is out of expectation, they will signal these things pretty heavily to prepare the market for them. Last comment was saying that 0.75% increase, it's off the table. Now, they can still surprise us and just decide not to give us any hints and just right ahead go for 0.75%. Now, my second argument is that while inflation number is disappointing and is higher than expected,
core CPI itself, which ignores energy and food, is only 0.1% higher than expected. It is still not good, but I feel like it's not to a point where they feel like they need to go for a 0.75% increase to lower this core inflation. And at the end of the day, I'm sure they understand that it doesn't matter how much interest rate you raise right now. You could go all the way to 2% or even 4%. You're not going to bring down the demand on food and energy enough to temper inflation on that side. That is more caused by global supply chain issue and war in Ukraine and Russia, and much less to do with overheated demand in the US. Now, I have redone the recording on Monday, but who knows, by the time I upload this, it will be Tuesday already. So maybe everything has changed and maybe a 0.75% is a guaranteed thing. But for now, personally, for the next increase, I'm still leaning towards a 0.5% as more likely. But again, also be prepared that it could very well be a 0.75%. Let's wrap up the video by talking about some tips for the following 12 months that could help you to better manage your finance. Now, number one, like I said, is always pay attention to your budget immediately. If you haven't done a budgeting, in the last 6 months, I highly encourage you to do a very detailed budgeting sheet. I provided a link below to a simple template that I always use or use as a guideline with my clients. And I would highly encourage you to track back the last 3 to 6 months of budgeting dollar for dollar, just to get a very good sense of how much money you're actually spending and where you're spending it. And based on the number you see on your budgeting, keep at least 3 to 6 months of emergency fund aside as cash. Don't invest it, just keep it in a high interest saving account, just in case we do go into a deep recession, you get laid off, or if you face any interruption in your cash flow or your job. Now, on the other side, if you are invested, like most people like myself, you probably have seen drops in your portfolio for the last 6 months. This is unsurprising. Here, I would say is be calm about your investment. Unless you have bought small companies that you felt has absolutely no chance of coming back. The worst thing you can probably do right now is just to panic sell or panic arrange your portfolio, especially you have been holding the blue chip companies. There's really no reason to massively overhaul your portfolio right now. It's down already. Sometimes I hear people say, hey, should I sell all my big tech, the Microsoft, the Googles, and I go all in oil right now? Or I just sell my portfolio completely and I go GIC right now. While short term, you will see an immediate improvement, I bet. For long term, these kind of moves, you probably are going to make it worse or make it even harder for you to get back your loss amount. So if you're feeling yourself getting emotional looking at the losses, calm yourself down, go away for a little bit, don't look at it so much, and then come back and really think about the companies you picked, the funds that you pick. How high quality are them? Are they really buying into the blue chip company? Do you really not see them be around in the next 5 years, or you believe that they will never come back? Like, really be logical and ask yourself these questions before you make any big move that you may later regret once the market has calmed down. Now, finally, let's talk about a little bit about properties and the topic of over leveraging. Now, one of the questions here people will ask is, should I lock in my variable rate right now to a fixed rate? And I would say the key here is to look at the spread. What are you paying in the variable versus what you're paying in the fixed rate? I'm betting the fixed rate is probably 4.75% right now, and variable you're probably paying 3%-ish. So the spread is about 2%. And for a 2% spread, personally, you're going to do some math and look at your own situation. But I would say sticking to a variable, you're probably still going to be better off for the remainder of your mortgage term versus locking in right away. However, if you're really unsure and you're just simply feeling uncomfortable looking at the rate increase, instead of locking a fixed rate right now and taking that 2% hit, I would suggest you to check what is the payment by the time you get that 2% increase. So at 4% or 5% mortgage rate, what are you paying? And then take that difference, the extra amount, and start budgeting that amount right now and pay that into your mortgage directly. So at least you are making a higher payment, but you're not giving it to the bank as interest. You're still paying that extra into your principal, which will help you with your cash flow by the time you renew your mortgage again. Now, on the other hand, you're someone that are holding multiple properties and you're feeling over leveraged, you're feeling cash flow is getting tighter and tighter or going into the negative. I think right now this is the time you really evaluate and you take a look at every single rental plus the principal home cash flow or expenses that you've been paying,
and see which one simply doesn't make sense to hold on anymore and it's just costing you too much money. One of the cheapest and probably the most effective way of offloading is to sell your principal residence so you skip the tax and then move into one of your rental. And then from the proceed of your sale, which because you don't have to pay tax, you keep a bigger amount, you can use it to pay down even more debt, which will significantly reduce your cash flow needs. While it is important to focus on the real estate appreciation in the future, I would say don't be too fixated on it. If you're already at a point where you're stressed and you know more rate hikes are coming, and also insurance strata property tax are gonna increase. If you're feeling stressed, maybe now is really the time to revisit that cash flow and plan for exit for at least one or two of your properties. Alright, so that's everything I want to share today. Just want to present a more neutral view on inflation and stagflation itself. Other than that, make sure you join our private Facebook group if you want more contents or just want to have discussion about money in general with our other 5,000 members. Next one I want to hear from you is what do you think about these scenario and situations, and what do you think is going to do to the housing market or the stock market itself? Let me know in the comment down below. And you like these kind of video, I do upload them 8:30 EST every Tuesday. Make sure you like the video and subscribe to my channel, and also click the bell button so you get all the notifications. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!